Greetings, everyone. My name is Samantha LeDuc. I'm the founder of LeDucTrading.com and CIO of LeDuc Capital LLC. I have, if you can also see this, let me know, David, if I bring anything into the screen, you can actually see my website. LeDuc Trading.
Yes, that's good.
Yeah, good. Okay, good. LeDucTrading.com, which is more for retail traders. I also have an institutional offering, which for those who are interested, you can, sorry about that, get into a free trial to see how I am supporting institutional clients. But for today, what I wanted to share with those who may not know what I do is that I trade for a living and support clients who do the same. I am a professional female options trader. I use primarily options, but also stocks and across assets. So for me, I'm looking very much cross-disciplinarian at the whole market, not just assets, but also all the reasons that could cause a movement. So I'm definitely a volatility trader, meaning I'm looking for momentum to enter any particular asset class, stock, if you will, and I simply am using options as my vehicle of choice to trade it and also limit the risk of that particular trade. So I can trade often, I can trade a lot larger quantity, if you will, of trades actively, since I run a live trading room, as well as swing trades and trend trades. So that's my number one, if you will, service that I add to for clients, which is running a live trading room, and it's very much relying on intraday anyway, the market moving news. So it could be obviously policies, political as well, since we got a lot of those headlines right now with the election. It could be macro themes related to the Fed. My job is to interpret what the news means. It's not just the data, but it's the context of that data. I am doing that live, of course, when there is something to see that's moving. And it also could be like a rotation. Right now we have a reflation trade underway in the markets because we have an a yield spike in the 10 and 30 year, which is creating this reflation into the oversold, economically sensitive plays. We'll talk about that more. So my job is to also spot rotation. So market moving news could be something fundamental, like when Chipotle had the E. coli outbreak, right? And that's a shorting opportunity in the room. It could also just be a rotation, which is basically like basket trading. So you see a whole bunch of tech stocks selling off at the same time. You see, commodities, running like hot fire flames, whatever. That type of rotation is typically also sentiment or news driven. So there's the macro, and then there's this thing that I do in the room, which is of course trying to size up where a stock is going to move, higher or lower. And I do provide client posts that explain my thinking of what's coming up in the market, what's going to move the market. Event risks, if you will, are a big deal. Tonight, of course, we have the presidential debate. We have the election coming up. Those are more obvious ones, but there are some more subtle ones, like the FDA has a vaccine meeting today to weigh if they have any really viable contenders for the COVID-19 vaccine in the pipeline of trials. So that's the kind of stuff that is definitely market moving. If there's any hint of a viable vaccine trial versus like yesterday where one failed, then that sentiment based on that market moving news will move the market. So that's what I'm doing in the trading room, in addition to educating clients to explain kind of my rationale and thinking in order to stay in trend with what the market's doing. So that's why I have 3 time frames. I have a chase, swing, and a trend time frame, and it's very much trying to anticipate volatility. So I was glad to be asked to present because this is my thing. I'm a volatility trader. I mean, this is my thing. I am looking for momentum. whether it's in value plays that will get scooped up, like is happening right now with a cyclical feel to it. Whether or not it sticks is another matter. Or it's a momentum play like the lovely IPOs, of tech, the SaaS and the work from home, contingency that moved very strongly on the e-commerce trend this summer because of COVID lockdowns and everyone working from home. Not everyone, but you know my point. The rotation or the new trend, if you will, and what that meant for a lot of the cloud plays. So these are the things that I'm looking at for clients on different time frame: chase, swing, and trend, anticipating volatility as it moves the market, as it moves a stock, as it moves a currency, commodity, interest rates. I don't care. They're all related. So that's why I am the backdrop, if you will, of interdisciplinarian, because I'm using these different modalities, not just technical trading analysis, which is definitely very core to what I do in my trading room, is sizing up opportunities to identify low risk entry and then price targets. For sure, I want to be able to help clients kind of envelop that that time frame that they have, whether it's short duration, medium or longer term, and then back it up with the macro, the fundamental. Intermarket we'll talk about in a little bit more detail, but it's spying divergences, and we'll get into that. But sometimes I can tell with some of my breadth analysis and volume and quant, option flow, big words, but the point is I can tell under the surface where there's a building up of positioning, and the positioning is large. It's not like retail, that's small. Collectively, retail can be very large, like the Robin Hooders this past March that came into the market because of lockdowns. They were collectively swamping with their call buying, and that helped the market obviously make a very quick recovery and a euphoric one. But they were not big orders. They were lots and lots and lots and lots and lots and lots of small orders combined. So we'll talk about that. But those are some of the things that I look for in an underlying as well, is the amount of call buying or put buying, etc. So that's, long story short, I'm volatility trading because I'm looking for momentum and I'm looking to time the market for clients. So I gave you a little overview of those buckets, if you will. My style of analysis, I deem macro to micro, because I look at the big picture and then I distill it right down to a trading setup. This is my thing. I know everyone has their specialty. My speciality is not macro or fundamental or technical or intermarket or sentiment or psychology, if you will, of trading. I like to scan and synthesize all of it. And then that gives me a higher probability of this rotation that I mentioned. So one thing that I really like was a guru and mentor who actually kind of tapped me with this quote saying, "This is my value to retail clients." So Mark Chandler is chief market strategist at a very big firm and saw my approach to trading to help operationalize, if you will, this data into a context that retail could understand. So I don't come from this Wall Street buy side, sell side world. I have taught myself, and these wonderful mentors that were open to teaching me, like a Mark Chandler, and he's a currency expert and has written books on it. So I am always a student, long story short, but now I'm mentoring those who are, wanting to understand why a stock moves, right? And then how to trade it is the technical. So these are the time frames that I work on primarily. A chase could be a few hours, a few days. It's really personal preference how anyone kind of defines a chase. Some people go to cash at the end of the day, they're day traders. I am someone who has no problem holding overnight for a few days, but I'm expecting a pop or a drop of size to, basically explode the IV, which is the implied volatility of a particular option. Or in some cases, that implied volatility is crushed because of an event. Like, for example, we have the election coming up. If it's an uncontested election, the IV, the volatility right now that's very elevated, and I'll show you that in a little bit, is going to collapse. So it's kind of place your bet, because if it is uncontested, obviously it's going to stay very bid, meaning volatility. So a lot of institutions are having a hard time, even not just retail, but institutions trying to figure out, okay, so how do we play this election volatility? Because we're likely going to have some. No one knows. So the swings that I trade and help clients kind of capture, if you will, are trades that will take a little bit longer, 1 to 3 weeks, for example. Now, we've been shopping around the past few days. I can show you on a chart a little bit better, but you can see where we've had some gyrations the last few weeks, and that has actually created a lot of opportunity, long and short. It's been more of a two-way market. It was straight up for a while. So the swings right now, how to employ them over a period of 1 to 3 weeks or 1 to 3 months, given the election, given a potential contentious election. How about December 1st? We might have a government shutdown again issue that comes back up. In other words, there are definite risks to this usual time frame, but now we have it heightened because of the election. And trends are something that is typically lasting a little bit longer, 1 to 3 months. And in that particular case, I use options that are more 3 to 6 month time frame. So you can see how I'm generally addressing, if you will, every single setup. I look at it from the standpoint of when will volatility enter, and is it going to be a few days, a few weeks, a few months, and that will dictate the kind of option that I choose. If anyone has any questions, just ask. So I don't know how much of folks are into trade management, but I threw this in here just to get at it before going into a little bit more detail on some educational stuff around VIX and timing market moves. But for me, because I'm doing this really on a intense time frame, if you will, meaning the trading room, I'm doing lots of analysis and engagement, but typically I'm doing smaller trades, 1 to 3% of available equity. Some people are more position traders. They'll have 10% of their book, into high probability trades for them, and they'll hold it no matter what. So they might have a fundamental thesis, for example, whether it's an oncology stock, cancer, or a growth play, the Zoom, work from home thesis, whatever. They'll hold it and they'll have a large position. That's not my thing. I typically trade momentum and lots of momentum plays. So it's smaller, more frequent, and the whole goal is to anticipate volatility. So the point I wanted to make was my approach might be a little bit different because I have 3 time frames, but ultimately I am lawyering a trade. I'm trying to take the bull and bear argument as if I was a lawyer on a case. I don't want to assume one way or the other. I don't get married to one side or the other. They both pay. So I want to be just aware of, if I'm bullish, what's the bearish argument? If I'm bearish, what's the bullish argument? And I work that stuff out all the time on paper, for my clients in my posts, because I'm actually trying to make sure I'm looking at the whole spectrum of risk. So that's how I approach, if you will, risk management. And now we're going to get into volatility and why volatility matters. So one of my kind of claim to fame, if you will, of being a volatility trader is that I have been very successful in timing market turns, big ones. So calling tops is actually a heck of a lot better for me than calling a bottom, because tops are a process. They really, really are. And I can use my intermarket analysis to see divergences under the surface. In other words, I can see, again, that kind of positioning that's happening underneath the surface, long or short, and I am waiting for confirmation. And then we have obviously some really big events. It could be, and it could be in a particular asset class like gold. It could be bonds, you know, a yield spike. I like timing yield spikes. It could be just the market in general and what risks are going to cause a big turn. And then typically those build up under the surface, long story short. Now, the bottoms, however, are a lot harder for me because they're typically intervention. Sorry, that's going off like crazy right now. My the market's open and so are my trades. So this is another issue where we have usually intervention. Like March 23rd, the Fed came, you know, after this big drop, 35% drop from February 22nd into March 23rd, they came in and intervened in the market, right? They backstopped. We had a whole bunch of global QE actually and monetary policies that came into place to, you know, cash swaps internationally, and, you know, low rates were cut to near zero, et cetera, et cetera. So that intervention created the floor from which we then calmed down and then started to rise like mad because liquidity was coming into the market. So that's an event. Tops are easier to call. But what is volatility? And so why am I, you know, able to kind of look at that whole top that's forming and able to call it early? There is Artemis Capital, Chris Cole, he's just, you know, genius, but not necessarily approachable from a day-to-day standpoint as far as market timing calls. But he has a really good graph that I love. Volatility is reflexivity between credit and liquidity. And I don't know if you noticed, but this is the VIX underneath in black. Up on top, you've got the red backdrop and then the gold on the bottom. This is very much credit conditions, volatility, markets, but also banks start to tighten, and it's a process. So for example, volatility started getting elevated in 2007. We didn't have the waterfall cascade until October of 2008. Lasted 6 solid months before we had intervention, this stimulus, right? And that whole period of time can be seen in what I have, which is called a stock bond volatility ratio. So he's using his system, I'm using mine, but the point is, I can see when volatility is elevated and stays elevated, which means banks are reporting that they're tight. In other words, standards are clamping down, and that makes it very hard on a lot of businesses, especially small businesses right now, which are, we already know for other reasons, because of lockdowns and because of, you know, consumer fear, they're shopping online, but they're not eating out at restaurants and going to the gyms and, you know, movie theaters and such and cruises. So that whole service industry has been decimated. And I will mention also that 2/3, I mean, we are literally, our GDP is more than 2/3 based on services. So we're doing fine in the goods department. We've recovered in full. People are buying stuff and homes, that migration, you know, from cities to suburbs, suburbs to country. But this is definitely, I would, you know, push strongly, a big deal. That volatility is staying elevated, banks are staying tight, and the credit cycle will create this compression and corporate defaults. So there's a saying that I like to use, big picture again, but policies lead the economies, right? So whether we have a Green Deal or we get a Biden or a Trump, what are the policies? And then the credit leads equities. Well, guess what? VIX leads credit, leads equities. So we have an elevated VIX, period, and it's going to stay that way. And I'll show you another chart coming up that shows you how extreme it is. There is a lot of danger when we have that situation, and the only thing right now, short of you know, I don't even know what you want to call it, a vaccine, if you will, is just really, really getting used to this. And of course, no one, that takes a long time. So we're waiting for fiscal to save us, but that's also taking a long time. So right now, my point was this volatility, credit leads equities and volatility reprices everything. We are still at risk of another volatility expansion, not just because of the election, but also COVID reappearing. And just plain and simply because we've got some, delays here in the fiscal, and the market's going to grow weary, especially if we have a contested election. So just be on the lookout for that. So now specifics around volatility. This is a little bit under, let's say, not your traditional technical analysis, I know, but I like to educate, right? So I'm a trader, I'm an analyst, but I also, this is the education part. So I like to look at quant analysis, which is the fund flows. And we're talking about the large institutional players called CTAs, which are basically very mathematically oriented with their buy and sell programs. So we started to see large call volumes forcing the markets higher back in early September. And then and by the way, dealers must hedge by buying stock, which makes that whole move. Actually, we started seeing it earlier in the summer, of course. The Robin Hooders came in and said, let's buy Tesla, and so on and so forth, and Apple and whatever. So the call buying was ridiculous. It was just tens of millions worth of contracts on a daily basis in some of these tech plays. And that forced dealers to buy more stock. And by the way, it didn't really slow down until this, I sent this note on September 4th, which basically was, okay, believe it or not, my tell that we're going to pull back now is VIX. So VIX had risen, a very strong impulse, and then it started to drop and the market started to drop. And I had written, when the market and volatility decline, then this single stock gamma game is up. In other words, the dealers were trying to hedge this gamma flow, it's called delta hedging, but basically the positive gamma beget positive gamma. And I said, when that stops, volatility won't act as a hedge. The market will fall, volatility will fall, bonds are at zero, so the yields are at zero, so bonds won't help you at all. Gold and Bitcoin won't act like a hedge. It'll be sold off as well. So the only possible way you have to manage a drop in your portfolio is to master options and the short setup. And we dropped 10% in the SPY and 14% in the NASDAQ. So gamma flows changed the game. This large optionality that had been going on until February, March, when we had that sudden 1 month drop, right, in the indices, 35% drop, the shorting of volatility programs blew out. Some of them made money, but by and far, it was a disaster because it just got ahead of them. The volatility exploded like never, ever before. And so now those strategies were dead on arrival. They can't be used anymore because they were too dangerous. Funds blew up. So they had to come up with a new plan. So this ended up being extremely bullish, with retail coming in and literally making up 50% of the call volume. And they just kept coming in. The Barstool, sport guy there. This was that particular reason why the market went higher, unrelentingly higher. And then when we actually pulled back, it was also because of this. So then recently I mentioned in my a September 22nd note, I had one called the Biden bid and value rotation. So the market was now going to be pricing in a Biden win. It was even before the blue wave win, but the Biden bid is what I called it, and the value rotation, which means things are going to stop going down and stuff that's short will start to rise. In other words, the hedge funds that were really, really big in shorting. Let me just show you something real quick. Oh, See, I should have had it ready. It just occurred to me and I really, really wanted to, but I can't find it right now. Anyway, the basket of heavily shorted stocks, like the GameStops of the world that had been left for dead, started rising up off the ground like magic, and they have just been on a tear. Literally the Tupperware, the GameStop, lots of stuff that was really left for dead had started to rise very quickly. It's been a great trade, and I think it will continue. Then this note that I put out was my intermarket analysis, which basically shows representative like relationships, strong and weak under the surface. My point was political drama, and I wrote that to clients, drives future volatility. And I'm gonna show you a chart of what I mean by that. And in short, the US political risk for the market has increased, with the likelihood Congress delays the passing of any CARES Act until after the likely to be contested election results. Now, there are all kinds of opinions on whether it's contested or not, who wins or not, you know, the fiscal deal passing before the election this year, who knows or not. But my point is, we don't know. So volatility just goes up. The IV in volatility just runs into the hot, hot sun because it doesn't know. So that was my logic basically then, that volatility would rise in October. And then I said, I'm expecting a move from contango into backwardation. So now let me show you the charts to back this up. So first, this is what it looks like. This is the S&P implied volatility term structure, okay? Do you notice how it went straight up like a hockey stick? So here's the election risk, if you will. And then, by the way, we have some other dates that come in after that, which would be the Electoral College decision. It's called the Safe Harbor deadline of December 8th. Et cetera, et cetera. So then we have January 21st, which is supposed to be the swearing in of the new president, or existing, but it's the inauguration date. So you can see how volatility just went hockey stick straight up. So that means implied volatility. That means stuff got more expensive. So before it was before this, calls were very expensive. And the Apple, for example, they just kept bidding it up. Price kept going up. It was ridiculous. It was up 40%, you know, in a month. Calls were very expensive. Now that crashed in on itself, okay? And then we enter September with that pullback. Remember the pullback that we had in the Qs, 14%. And then boom, volatility took off again with election risk when Trump said he may not vacate the White House, even if Biden is shown the winner in the popular vote or electoral. He thinks it's all rigged. So that is what caused that volatility surge, and it's staying elevated until we know more. So likely February, March is where they're betting right now that electoral risk will actually come down. And how do I know that? Because a very, very, very large option contract came in last week for February and March, 360,000 calls, where they're doing basically, it's a put ratio spread, but they're selling it, which is bullish. And that particular spread says, and right now we're about 27.30 in the VIX, they're betting a lot of money, these are institutions, not retailers, that February, March timeframe will likely have a vaccine, or at any point, in any case, we will have lower volatility, because that particular trade that they set up is expecting volatility to go back to 17. So we went straight up. This is election risk, electoral college risk, inauguration risk. And even though this particular term structure is showing a slight decline, it's really going to be, I think, with that bet that they made here in February, March, that's a bet that we're going to have a vaccine by then. So again, that was a bet that VIX would come back down to 17. Whether or not that happens, who knows? But that was a very large bet on volatility returning. into more normal in February, March. So what's going to get us into February, March? Because that's many, many months away if you're a day trader or a swing trader or have a portfolio that's at risk with the election, right? With political drama, on the fiscal relief, on the COVID cases spiking, which, by the way, COVID cases are spiking. So this, hold on one second. This is used by the White House and others. It's Institute for Health Metrics and Evaluation, where COVID cases right now are modeled, it's an MIT model, to be one of three things. So if we don't have any mask mandates, we're going to spike much bigger than the first spike back in April or the second minor spike in August. If we have some kind of mandates, you know, will be right about here. That's the current projection because they don't know if it's going to be a Trump or Biden win. And if it's Biden, there is a universal mask mandate that he's already populated, and the cases would come down here. No, this isn't, sorry, deaths would come down here. So we know that cases have obviously triggered in the third wave, and hospitals are getting stressed and countries are closing borders. For example, EU already closed their border to the US many months ago, but now they've closed it to Canadians as well. So countries are closing. You still have restrictions in some cases between states, which is crazy. New Jersey and New York, come on. New Hampshire and Maine, come on. Schools are going, they started, you know, in a classroom, now they're right back. Boston, boom, get your butt back into your seat at home. New York City, I mean, there are so many now restrictions coming up because this is another risk event. So my intermarket, which is this VIX backwardation, is not markets bullish message right here, which was to 2 clients, is that I expect more volatility, and this is very much coming up, but in the next few weeks. Now, I'm not saying it's election related. It could be COVID. It could be the fiscal deal. It could be escalation between China and Taiwan and US intervening. I don't know. But the point is, this is a 3-month volatility index. It's VXV. It's not on your, you know, normal stations of charting. It's not trading. I mean, you're not trading it. I use it to determine, if you will, and to better gauge when volatility will enter the market so that clients can protect their longs, or so we can position with calls and volatility or puts in the indices, or again, you know, the rotation thesis from tech to value, that kind of thing. So this was taken on the 19th, but it is percolating in this wedge. If it was to drop, it's very market bullish. If it explodes higher, it's very market bearish. But this is the backwardation that I was kind of mentioning. And anyone who's familiar with volatility studies, when VIX is greater than VXV, it means it's risk off. So they're hedging immediately, either selling or you know, buying volatility. There's definitely a flavor of whenever backwardation, which is dropping below this 0 mark, we have a risk off event. So above is kind of normal. And right now we're still normal, not so much. I think we're down to 0 or pretty close to it, actually. Today we bounced again. So we've done this before. We bounce, we can definitely bounce, but when we break, it's a big deal. So this is what happened. You can't see it, but this is 2015. That was a China devaluation. That was unexpected. That was definitely a currency kind of maneuver. And we had a ginormous pullback in the market, a volatility surge that caused a pullback in the market. We had another one in October through December of 2018. It was October 3rd. Our 10-year yield just hit 3.2, and I tweeted that emerging markets would be under stress and we would have a sell-off. And we ended up having 20% drawdown into Christmas Eve, December 2018. I remember because I was with my girls in Vienna where they go to school. And then München got on the phone with the banks and intervened. So I can see when stuff is pulling back, but when they're going to come and save the market, it's a little bit trickier. So Christmas Eve, we obviously rallied, but the point is I can also use pattern recognition and technical analysis like trend lines and the rest to kind of indicate when we're going to have volatility. So this was February, this was March, right? Biggest volatility surge. And now we're kind of chopping. And this to me is just one of those indicators that I use for intermarket that helps me gauge, what's next. So I'm looking at the backwardation as not being market bullish. A surge in volatility is coming, but it looks like it's a few more weeks. And we have end of month flows, of course, coming up, which is typically bullish into a new month. We also have a typically bullish, Santa Claus rally, but the truth of the matter is we don't know what's going to happen on November 3rd. So everyone's kind of like, what do we do? What do we do? And so recently there started to be some profit taking, like the Pelotons and the Zooms of the world. They started, thinking, I've had this amazing run. It's time to take some chips off the table. Or the solar space, which had an amazing run since July, and they started to take some chips off the table just this week. So they're getting ready. They're getting ready for volatility. They're front running the volatility. So VIX is wicked elevated. I mentioned that. I forgot to put it in here. And here's the thing. What's a good hedge? So when we pulled back in September, right, there was no hedge. And people were like, what the? Because volatility was not a hedge. And I knew it was not going to be a hedge this one particular time. And free people were, okay, gold's going to be a hedge. Nope. Bitcoin's going to be a hedge. Nope. Bond's going to be a bad hedge. Nope. Only thing that was a hedge was dollar. That's it. They went to cash. Boom. The dollar popped up. Now, did you notice the past few days how Bitcoin's been acting? So Bitcoin is acting like a hedge right now, more than VIX. So VIX is falling because where's it going to go? It's already way the heck up here. I mean, I don't know if you can see my cursor, but I'm pointing at it. So volatility is not a hedge right now. It's already elevated. It's waiting for you. So it's tough to layer on volatility. Having said that, I have a volatility call in case we have something totally wicked, scary happen. But for the most part, it's going to be tough to use an elevated volatility as a hedge against a portfolio, especially if we do have an uncontested election on the 3rd. That premium is going to implode, or it's called an IV crush. So you'll lose money on your volatility hedges unless you know how to sell it. And then you have another issue. What if we do have it contested? It can even go higher. There's not a really good play here on volatility that's easy. It's very tricky. So, and unfortunately, gold, silver miners are still not acting like a hedge because they're still an asset. And they're also already overbought. They were way accumulated. It's also totally dependent on inflation expectations from a QE event like a fiscal policy. The fiscal's been kicked down the road. So I actually had a recommendation to short gold back in early August, pressed it in September because there's no remedy, there's no resolution on this fiscal. And the longer they push it out, the longer gravity pulls gold, silver, precious metals, if you will, lower. Once they pass it, it'll shoot up. No question. I'm a firm believer it'll shoot up, but it's not looking like it's going to get passed until next year. A vaccine doesn't look like it's going to get passed until next year. The election results, we have a risk it's not going to get resolved until next year. So my point is, I think that's one reason why they're going into Bitcoin. Dollar hasn't moved very much. It's not really serving as a hedge right now because we haven't had heavy selling. We have earnings season, 300 companies reporting this week. We have the hope of an FDA meeting that's going to be market moving. We have the hope of McConnell and the GOP Senate passing some kind of, short-term, medium-term, any kind of COVID relief bill. But the reality is we really don't have a lot of certainty and we don't have a lot of good hedges. So right now, since the talk is on volatility and I'm trying to more educate on volatility, that volatility is pricing in only an 8 to 9% expected move over the next 30 days. That's nothing. When I was, where is this? Right here. When I was bullish volatility back in February, before this absolute collapse, look at the volatility went through the absolute roof, right? So this was, hold on just a second, a 50% move. 22 to 38. Yeah, so we moved 50%. Oh, sorry. In regular volatility. So that was definitely not the expected answer when I looked at volatility going, okay, what's the expected move in the next 30 days? Only 8 to 9%. That's not a great hedge. So hence why I believe that Bitcoin is being bid up, basically. So what are we? Let's see, 242. Okay, so kind of levels, VIX levels to trade by. How do I do this? That will help. Okay, VIX levels to trade by. Every day, I actually do technically analyze VIX charts. So I look at, for clients, and also in my trade assessment and in my macro to micro written assessment, I'm always looking at the macro backdrop, right? What's the Fed position? Is there any change there? What's, of course, political that's going to impact policies and event risks. Right now we have, you know, COVID cases increasing, et cetera. But we have earnings right now, lots of earnings, and market moving news is all through the day. It's heaviest in the morning, which is why I do the trading room in the morning, and there's lots of really good juicy shorts and juicy longs. Oh my goodness. But for the most part, I'm using this technical analysis of these indicators, and I can show you right here just for an example. Who says you can't, you know, technically analyze VIX? I've been doing it for years and it works extremely well. I do use it against a backdrop though of intermarket as well, and I can show you some of that. But for example, here's VIX on a weekly. That happens to be a day, that happens to be an hour. This is what I call time frame congruence. So if I have a little, you know, time here to show you, we got a wedge here, okay? Not a big squeeze on a weekly, that's a Bollinger Band squeeze, but we do have a wedge, and you can see how it's popping out. It's starting. We had already hit around 30 before it came back in. 30 on the daily is the 200. We get above 31, we're gonna quickly go to 34. We get above 34, we're gonna quickly go to 36. We get above 36, we're gonna quickly go to 40, and so on and so on. But the fact is that it's intonating higher. So I'm looking at VIX because I believe firmly you can chart VIX. That's not a big deal. I also chart volatility of NASDAQ, and here's a bigger wedge. So it's coiling, and you've seen what happens when you have a coiled stock. Well, you can do the same thing. This happens to be on a weekly. I don't know when this is going to blow, but there's no way in my personal experience of doing this for a few years that this is going to stay here. Nope, not a snowball's chance. So this is a wedge, maybe another week. I don't think it's going to wait a week. I think it's going to blow. Now, if it comes down, that's market bullish. If it goes up, that's market bearish. So technically analyzing, and by the way, that is a Bollinger Band, but it's not very, you know, that's not very compelling. It's the trend lines, if you will. Nothing else about this chart is compelling. It's sideways chop. It's above the 200. It's elevated. It's tried a few times for the past month to get, you know, since the September, by the way, that was leading into September. That was a September drop. There was no hedge in volatility. No joke. It went from 47 back down to 32 while the market dropped. That's what I was talking about. From that, literally September 4th, no volatility hedge while the NASDAQ and the SPY dropped. So now we've just gone sideways like a snake. That's no fun. We can get in clear and stay above 37 and change, then we will have risk off. Right now, there's no movement, but it's coiling. I can do the same thing with VVIX, which isn't so much fun right now intraday. VVIX is the volatility of volatility, but I can still put some, you know, levels on it, and I can time some nice, you know, few day pullbacks, which I have done, and that's still working. Again, kind of a trend line. It's starting to move out, but nothing convincingly. So that's what I mean by VIX, VVIX, VXN, which is NASDAQ volatility, especially for those who have lots of tech holdings. There's SVXY, which I use as well to kind of, all right, it looks kind of bullish, but typically when we hit the 30-week, we come back down. Maybe not. Maybe this is just really market bullish. So, and of course my, what is this thing that I use? The XVN. So lots of different volatility that I try and chart, as well as the backdrop of news and events and macro. But some of the things that are kind of, I think, exclusive to at least my model of analysis is something that I use called intermarket divergences. And I have a few of these I'm going to show you kind of briefly, which help me time sector rotation. That's separate from the quant stuff, which changes every day, which changes every week, because basically option flow has incredible, now anyway, 7 days. They're bidding it up for market movement in 7 days. It's one of the reasons why, you know, that pullback was just ridiculously fast. They're getting more and more short term. It used to be, you know, they would more like a calendar. They would do a near term and short a later month, but now it's just 7 days. It's become very, very more chaotic, basically. But so the intermarket keeps me, you know, focused on the bigger picture, because quant is very short term. Sentiment can also be very short term, and technical analysis, it needs a trigger, right? So you're waiting for some kind of trigger. So I use, some of these are on this platform and some are elsewhere, but there is an indicator that I really like, which is on this particular TC2000, which is called the Cumulative Volume Index. And I use it, well, I'm gonna actually not use that one. There we go. I use it for divergence with a SPY fractal underneath. It's one of the ways that I could tell that we had a divergence, was that SPY price was going up, but this cumulative volume index, which I use every day in my trading room, was going down. So that was a divergence. This was January and this was February before the sell-off. And you can also see how closely this fractal trades with it. Now we've gone up here a few times on this trend line, which is on a day time frame. And this is really interesting to me because we tagged it, kind of pulled back, tagged again. It looks like it wants to break out, doesn't it? So the market actually looks pretty bullish in some respects, even though it feels weird to say that. And I have my volatility coiling. So the best I can come up with is this is actually going to break out, and it's going to be a fake breakout, and it's going to be a fast failure. So this is one of the breadth indicators that I use. Some others that I use are NYSE, and I basically chart it and I use MACD, and this is rolling over, but what if it bounces here? Maybe we have a little bit more to go. So my job really is to kind of figure out my indicators and what they say, and then try and time the volatility. This is a put call ratio that I came up with, and it is way noisy to explain, but long story short, I know what it means, and it needs more time. I know what this means, and it needs more time. I can look at the volatility coiling, and I can see it needs more time. So my point is that I'm using all this behind the scenes, right, with hopefully, you know, just some common sense that it's always going to be opposing forces, and I got to figure out which one's stronger, like a boxing match. And my job is basically tell clients when I think it's safe. You know, stay in that trade. It hasn't done anything wrong. Or, okay, wait a minute, this looks like profit taking, like Peloton the past few days, and Zoom, for example. Using the intermarket, so I'm not trading. I have a very clear political opinion, and you get that on Twitter, by the way, but you're not going to get it in my write-ups and in my trade setups because they don't have a place, except when it comes to the volatility. I try to write a narrative to the volatility. What's going to create the volatility? Is it COVID? US-China trade escalation? Is it, we had the Biden bid going on. Is he going to do really well tonight and that continues, or is he going to do really poorly and we, fluster a little bit in the market? Election contention, big deal. Fiscal bill, big deal. So that's what I'm trying to do, sizing up, if you will, the data, putting it in context, and then basically relying on just some good old-fashioned mom radar, because I raised 3 teenagers, and that's why I really think I'm good at volatility. So let me know if you have any questions. I am found here. My Twitter handles are Samantha LeDuc, and then I have another one which is linked to StockTwits. It's LeDuc Trading. I have a website, obviously, LeDucTrading.com. That's for retail, and then I have an institutional offering, which is LeDuc Trading Edge. I also have, thanks to James, thank you, David, for putting that in there. And maybe you can grab this too. Where'd it go? It doesn't matter. All right, so I have also this offer that James, my marketing director, client services director, put together, and it is an offer for those who want to try out my service. It's that straightforward. I have a trading room from 9 to 12. You get lots of custom engagement if you want it, or you can just attend, observe. I go over whatever inspires me for the day and also what's moving for the day. And then I kind of figure it out in the afternoons and write up my thoughts. And again, try and always look for the risks with the opportunities and time the big market moves, big market moves. So that's my offer. It's, I believe, $100 for the first month. And hopefully you will get some good feedback, if you will, on what you're doing, and I can help you do it a little better. Maybe you can also give me some ideas of what you're trading. I like to engage in the room. That's a lot of fun. Got some really good professional traders in there, also some newbies. It kind of runs the gamut, but you're welcome to check it out. This is my website. This is that thing. I'm trying to look for there it is. No free trial in the chat room. There's a day. So basically anyone can come in and pay for the day or the week if they want to check it out. That is definitely an option. And this is the promo code in case you were interested. David, did I hit your time frame well? You said get done by 2:55 or else I'm getting the hook.
Yeah, that was perfect. So thank you. Great presentation.
I'm getting a little better at this. Thank you.